Good morning, everyone. In the previous two sessions in AFM revisionary lectures, we had studied about foreign exchange risk and risk management. Now, based on that particular principle of what we have learned on foreign exchange risk, we take it one step further ahead and we go to the next module, which is your module number 11 in AFM, that is International Financial Management. International Financial Management. Right? Now, what do you mean by financial management? Financial management we have learned earlier as well. Remember, when we do capital budgeting, we arrange for finances. It's basically about any of the techniques which we have learned, where we were trying to essentially manage our finances to the objective or to a particular project. So how is this any different compared to that financial management? So you will have the principles of financial management being applied in the international environment, meaning your transaction is happening across the border. And that essentially means there will be involvement of foreign exchange. And by default, if foreign exchange is involved, there will be forex risk to be managed. Right? So international financial management is when you are essentially taking up any particular project or any financial management to be done across the border, that is outside India borders. Maybe you want to start up a particular entity or a particular business out of India. Then how would you go about it? Say, for example, in today's environment, we have US, which has levied, say, for example, tariffs of 25% on your goods. So currently, you are manufacturing in, say, for example, in Noida. Okay, in Noida, UP, India. So you are manufacturing in Noida, UP, and you have been supplying these goods to your customer in US, who is in US. This is UP, India, right? Now, generally, your cost has been, say, for example, $10. You add your margin of, say, for example, $5, and you have been invoicing your customer at $15. Right? If there were any transaction cost, etc., that transaction cost essentially are not being included in this $10, and the reason being, whatever is that cost is more often than not, you are getting some subsidies or export incentives that takes care of those costs. So in the magnum of the entire events, basically you are manufacturing for 10 rupees per unit, you are charging 5 rupees per unit as profit and invoicing it to your customer at $15. Now I am not even including over here GST, etc., for the simple reason in exports you generally get those export incentives, right? So you don't charge GST to pass it on across the border. Fair enough. Now this is the situation today. All right. Now today in the early morning, say for example, US says, okay, this particular business is going to attract 25% import tariffs. So what happens is my cost of manufacturing is not going to change. It will still remain 10. My profit is still remaining 15. However, the customer in US will now have to pay how much? Total of 25% extra, right? So 25% of 15 is $3.75, right? So now the cost for him becomes $18.75. Now this $3.75 can essentially be the difference between me retaining the client and losing the client, literally, right? Because I will not be able to absorb this cost within my $5 profit margin. At the same time, if the customer has to bear this 3.75, which import tariffs have to be borne by the importer. In that case, he is going to try to find another substitute. Maybe some other country which is not attracting 25% tariffs. So maybe somebody who is essentially right now aligned with the US. So say it's one of the Canadian manufacturers, and this particular commodity is not under US tariffs if it is manufactured in Canada. Then obviously I have a decision to make whether if this is going to be a permanent feature, now how do I go about manufacturing? So I am trying to identify what if, considering this particular business is already there. Say, for example, I am currently manufacturing and selling 10,000 units to US. Okay. This is from my UP unit. Now, let's say if I manufacture instead of 10,000, I'm setting up a manufacturing unit in US and I manufacture 40,000 units in US, right? Now the question arises, the capacity is only 10,000 units because you have been selling 10,000, but I realize there is a potential if I'm going to manufacture in United States of America, I can easily sell 35,000 units within US, and if required, I can even export it from there to the neighboring countries, which are friendlier states with US. So again, there will be some tax benefits, etc. happening. Now, if I manufacture 40,000 units in US, this is going to cost me, say for example, $8 hypothetically. I still will charge my $5 profit, and now I am able to sell it for $13 to my customer. Right? My customer is obviously going to be happy because now instead of 18.75, he will end up paying only $13. So he is going to save $5.75. For me also it is beneficial because now my cost of production has gone down. My profit remaining same, the overall profit percentage per unit has improved. So profitability for me has improved at a lesser cost. Plus I am able to create extra market. Right? Now, what is the challenge because of this? I will be selling this 40,000 units, yes, or 35,000 units extra. However, out of that 10,000 units which I was selling from my current unit, which is my UP unit, that will essentially be shifted, right? So in other words, I lose that particular sale from Noida unit, but it goes to my another unit, which is going to be established in US. So when I look at it overall, what is the incremental sales which I will have? About say approximately 30,000 units. 40,000 units minus 10,000 units, which I was already selling. So incremental is 30,000 units. Now I need to do the entire financial management. How do I arrange for finances? At what cost do I arrange that finances? How do I essentially raise those finances? Should I raise it in India or should I raise it in US? That's essentially about international financial management. So in a simple words, you can say it's kind of capital budgeting across the borders, right? All right. So what are the aspects which will come into play because of this? So first aspect, obviously, as I mentioned, when you have foreign exchange involved, there will be foreign exchange risk. There is a foreign exchange risk, and you will have to do obviously the risk management of that risk. There is also political risk, right? I don't know how many of you have read the news of late, but just about a few days back, or rather maybe 2 or 3 days back, Nigerian government has imposed a fine of US dollar 290 million on Facebook, now Meta, right? That is a political risk because that particular government has decided to levy penalty based on certain domain or certain, I mean, I'm not getting into the reasons of it, but it is a political risk emanating from that particular country, right? Earlier, this government, this particular company never faced such penalties in that particular area. However, now they are going to have political risk coming in, new kind of regulations which are coming, because if you will see that $290 million is also being divided into some $220 million for normal breach, some $38 million for transfer of data of Nigerian citizens out of Nigeria. So, and how some other spurious businesses or some shabby ads are being essentially, which are not allowed as per the laws of Nigerian country. They have been, some ads have been placed on Facebook or Meta as such, and as a result of that, you are violating those regulations. So there are some other penalties for that. So total coming to $290 million. Now that essentially again is a risk. The third one, of course, as I mentioned and gave you an example, is export cannibalization. What do you mean by export cannibalization? Any ideas what is cannibalization? Cannibalization is basically meaning that when you are trying to create this new manufacturing unit, which is going to give you expected sale of 40,000 units, but this 40,000 units automatically also is eating out my actual existing sale, right? What is my actual existing sale? 10,000 units, which I was already making from my UP unit. So now that 10,000 unit sale will not happen. Of course, I will have a 40,000 unit sale happening, right? So this 10,000 is considered as cannibalization because that is eating into my existing sale. So the incremental sale or additional sale is only the remaining 30,000 and not the entire 40,000, right? So what are the aspects we are going to have to manage over here under financial management or international financial management over here? So I have first of all to identify how to raise funds. Because remember, since I'm going to be setting up this unit or getting into this transaction across the border, I have to think whether I want to raise funds in my local currency, Indian rupee, or should I essentially maybe raise these funds in US, get some partners over there, or maybe issue some shares over there by way of ADRs or GDRs, etc. Right? American depository receipts or global depository receipts, as the case may be. So you have to decide or identify what is the optimum way of raising funds and in which country, in which currency, right? Both turning out to be the case. So I have to decide over here whether I want to use ADR, American depository receipts, GDRs. I may have foreign currency convertible bonds, right? Foreign currency convertible bonds. I also have over here, let's say, for example, a euro issue. If the underlying currency is euro, I can also do a euro issue, right? So that is one question which I have to address in financial management. Second question is going to be about one of the aspects is obviously capital budgeting, where you are going to essentially start your own unit. It is not always necessary that I have to start my unit, right? I could even outsource this particular entire manufacturing which I was doing in UP. I can just outsource it to somebody who is doing manufacturing in US, procure it from him, give him a specific order, procure it from him, then place your trademarks, copyrights, etc. as the case may be, do the requisite packaging and whatnot, and then you essentially sell it to the customer. This is exactly what majority of the US companies have been doing. And that's how China became the manufacturing hub for huge part of or huge companies in US, right? They used to manufacture in China, so it is made in India. They would essentially put it into the boxes of iPhone or as the case may be, whatever the company name is there, package it accordingly and sell it to their customers in US, right? So it was a simple case of outsourcing. So not necessarily you need to set up your unit. You also have the option of outsourcing that particular business and just book your profits in that case. Again, if you are doing capital budgeting, you will again have to deal with foreign exchange. Now, if it is foreign exchange, then you need to identify based on which principle you are going to essentially have to evaluate this, right? Because foreign exchange methods will have purchasing power parity method, which we have learned in foreign exchange risk management. Remember, interest rate parity, purchasing power parity method. So we need to essentially consider whether we want to go for which particular parity method, purchasing power, we want to consider interest rate or some other methodology, right? Then you have working capital management. Here in working capital management, it's going to be predominantly about liquidity management, right? Working capital is nothing but current asset minus current liability. So I will have to manage over here my liquidity, and that essentially means I have cash management. If you recall, when we were learning about the risk management hedging techniques, one of the hedging techniques was netting. Remember, what was netting? Netting is nothing but matching your foreign currency asset and foreign currency liability. Now remember, netting essentially requires that the obligations have to match at the same date. So when the netting does not happen on the same date, or that coincidence does not happen in your business, then that coincidence can be made to happen with the use of money market hedge. Remember, we had discussed that yesterday. Okay. In foreign exchange risk management, right? And further, you also obviously have to now look more closely into your treasury management, right? And the fourth important decision which you will need to do in international case is dividend decision, right? Because remember, any dividend that you declare, now you are going to pay in foreign currency, and as a result of that, there will be different implications. For example, maybe that dividend is exempt in India, or it is exempt in US, or it is taxable in India, or vice versa. Or maybe taxability is there across all, right? So maybe the same amount of income may attract double taxation for your shareholders per se. So you need to be very, very privy of what dividend decision we are going to take. Either you are going to declare dividend on a stable basis, a small amount, or you want to essentially have a company which is going to be actively dividend paying company, right? So that particular aspect becomes a very, very important decision for us. So before again I go further ahead, remember, in international financial management, it's basically financial management, but with international meaning across the border coming into picture. There are a lot of other variables which get affected, predominantly being the moment foreign exchange comes in. Foreign exchange, the risk obviously emanates, political risk and regulations of international countries come into picture, export cannibalization, where the new business may essentially eat into your existing business, right? Or it might essentially reduce your existing business. Then on financial management, there are four aspects to be considered. You have how to raise funds. So that is a case of, do you want to issue equity? Do you want to issue debt? How do you go about it, right? So if it is equity, remember, I cannot issue my equity directly in US market. So I'll have to issue it through American depository receipts or global depository receipts. So that is FCCB or Euro issue. We will take an immediate example on ADR or GDR to start with, right? How do we essentially go about it so that the concept becomes more clear? Then capital budgeting is another way where you are essentially, as the word itself suggests, it's a capital transaction where you will be investing some funds in a project, right? So here you don't have the option of even outsourcing, etc. You'll essentially have to do some capital investment. So again, foreign exchange being involved, you need to now identify what is going to be the moment of the foreign exchange in times to come, because you will essentially try to adjust that based on either purchasing power parity principles or some other principle, right? Maybe interest rate parity, so on and so forth. Working capital management. So there you have cash management coming in, because I need to ensure that I always have cash account. When we were learning foreign exchange and risk management, one of the topic which we had covered was Vostro, Nostro, and Loro account. Remember? So how do I go about paying those transactions? That will essentially get covered under cash management part. Also, the moment I'm talking about my current assets and current liabilities, one of the way to hedge your risk was netting, right? So if I'm able to net off my foreign current assets and foreign currency liabilities, right? So if netting is possible, for netting, remember, same day the obligation has to uh, become due. So I will receive US dollars and pay in US dollars, right? So that will have to be considered. Of course, if the dates are not matching, then I will have to opt for money market hedge to help me do the netting optimally. And next will be treasury management, managing different currencies. Now, this becomes important even for, say, for example, RBI, central bank also. If you notice in the last 4 to 6 years, RBI has been consciously upgrading their gold reserves per se, right? Because a lot of the, I mean, even in the previous Trump government, there were certain decisions which were being made by the US government wherein they were making it slightly difficult for parties who are not dealing in US dollars, right? Or rather, in some cases, they had imposed sanctions. For example, Russia had been sanctioned, uh, Iran has been sanctioned, and if we want to do trade with them, obviously we can't use US dollar. So what were the other ways? So we were trying to move slightly our treasury management, whatever was the composition of dollar, into maybe euros or some other currency. And you see, of late, gold has been one of the preferred currencies, not just for Indian central bank, but even for Chinese central bank and various other central banks across the globe. That is one of the reasons why gold has really gone up in the last 3 to 4 years from almost like 60,000 or 65,000 rupees per 10 grams into what it is today and crossing the 1 lakh rupee per 10 gram, right? So that is based on that treasury management. And last one being dividend decision. As I said, dividend decision is very important because it will lead to outflow of foreign exchange for you. So you'll need to be mindful whether your shareholder, uh, you have the sufficient foreign exchange to part with it. Two, what will be the taxability of it? So you need to be more sensitive to that particular aspect as well. Like Apple, for example, for so many years, in almost 25, 30 years, they had never distributed dividend. They would only capitalize it. If you want to recover some dividend, maybe sell one of your shares, because as Modigliani Miller had also established, that non-paying dividend is not going to affect the value per se which you get from the company. It only means that the capital value of that particular share will appreciate, right? So if I don't distribute that dividend, that value still remains in the value per share of that particular company. So that dividend decision being an important consideration. All right. Now, in order to understand how ADR or GDR gets priced, etc., let us take one simple example. Question number 1. Now, this question number 1, I have not shared in the reversionary assignment file because this was already done earlier. So I'm going to go back to that particular file, right? And we will refer to that particular question over here. So I'll bring this particular question over here for your easy reference. You can have a look at it, right? This is the question where we are essentially going to get some idea about GDR. Now, of course, I would encourage everyone and all of you. We had taken a couple of sessions on international financial management and we had solved almost 10 to 11 questions that time around, right? Today being the reversion rate lecture, obviously we will not be doing all those questions per se, but I really encourage and suggest that you go and refer to those 2 sessions because it will help you in effectively revising or rather learning the entire chapter per se with all questions. All right. Now, let's start with this particular question. Is it visible to everyone on the screen? Prashant, Shweta, is it visible?
But yes, but it is little small, sir.
Little small?
Yes, sir, it is visible.
Okay, so what I will do is slightly enlarge it. Okay, does that work now?
Yes.
Okay, all right. Now, X Limited is interested in expanding its operation and planning to install manufacturing plant at US. For the proposed project, it requires a fund of $10 million net of issue expenses or flotation cost. The estimated flotation cost is 2%. To finance this project, it proposes to issue GDRs. You, as financial consultant, is required to compute the number of GDRs to be issued and cost of the GDR with the help of following additional information. Expected market price of share at the time of issue of GDR is rupees 250, face value 100 rupees. Two shares shall underlie each GDR and shall be priced at 10% discount to market price. Expected exchange rate is rupees 60 per dollar and dividend expected to be paid is 20% with growth rate 12%. All right. What are we asked to find over here? Compute number of GDRs to be issued first and foremost, and then what is the cost of GDR with the help of following additional information. So basically, this particular GDR will have to find cost of equity, right? Just like KE we used to find. If you recall, how did we find KE? It was D1 upon P0 plus G. Am I right? I hope you all remember dividend growth model, right? D1 upon P0 plus G, right? So here, first and foremost, I need to find how many GDRs I would need to issue. So how many GDRs would I need to issue? So first and foremost, you need to understand what is the total amount of money you would need to raise. So over here, how much amount would I need to raise? Yes. What is the gross amount of GDR to be issued? Is this visible now? Or should I increase the size of the...
No, it's okay, sir.
Okay, all right. So gross amount of GDR to be issued. So how much will that be? I need 10 million, right? However, you know for a fact, if I issue 10 million, I will not get 10 million. And why is that so? Because I have to essentially pay something known as flotation cost, right? So I'm going to get essentially, if I issue $100, what I will essentially get is 98. So if I want 10 million, how much would be the case? I repeat once again over here. So if I issue $100, what I will actually receive is only $98, right? Because 2 is flotation cost. So I want 10 million. This is what I want actually. So that means how much should I issue? Gross issue, cross multiplication, right? So you can do it either this way or you can say 10 million divided by 1 minus 2%. Are you all with me? Okay. So how much will
Yes,
this
sir.
come out to?
1 crore 2 lakh 4,081.
See, so let me put it over here, Control V, and I will remove the. So this comes to So it comes to 1 crore 2 lakh 4,000. Remember, 10 million is nothing but 1 crore. And now what we have to issue because of this 2% flotation cost is 1 crore 2 lakhs. Right? All right. Now, further, what is going to be the issue price? What is the issue price? Issue price per GDR will be how much? We are told in the question over here 2 shares shall underlie each GDR and shall be priced at 10% discount to market price. So how will that work? How will that work? I have 250 rupees for 1 share, which means I'm going to have 2 shares, right? So that is 250 into 2, 500. Further, I am told that I have to essentially issue it at premium or at discount. Discount of 10%. Are you with me? Yes? Hello? So it will be 250 into 2, 500 rupees into 90%. Why? Because 10% is the discount which I will have to give. Further, this I have to convert it into US dollar. So how do I convert that into US dollar? I will divide this with 60 per dollar, right? The expected exchange rate is 60 per dollar. So I will divide it by 60 rupees so that I get dollar value. So let me take it over here. So I get $7.50. This is dollar, right? This is dollar. 7.5. So I have now received what is the gross amount of GDR to be issued, total amount I need, how much is the issue price per GDR. So now can I find number of GDRs to be issued? Number of GDR to be issued will be how much? Number of GDR to be issued will be how much? One crore, 2 lakhs. Mind you, this is all dollars. Divide by 7.5. So I'll get 13 lakh 60,544.22. Now remember, GDRs cannot be issued as a fraction. Okay, so you will not be able to issue these in fraction. You will need to round it off. So either you say 44 ka 45 so that I will able to achieve my money, right? If I have $4, $5 extra, it's fair. But if I will have $2 short, then there can be a challenge. So even if it is 0.22, you round it off to the next number. So you mention it clearly, round it off to the next number. All right. So these are the number of GDRs to be issued. Now, what is going to be the cost of GDR? Because that is what the next question is. They're asking us cost of the GDR to the company, right? So what will be the cost of the GDR to the company? So what is the cost of the GDR? Cost of GDR to, what is the name of the company? X Limited. There I will say it will be, what is the dividend? Dividend I am told is 20% with growth rate 12%. So you will pay dividend of 20% on what? 20% will be of 250 market price or of the face value 100 rupees. Yes.
Face value 100 rupees.
Face value 100 rupees, right? So I am going to have over here 20% into 100. How many shares? 2 shares. Am I right? So my total dividend comes to how much? I believe it should be 40 rupees for 2 shares because each GDR has 2 underlying shares, right? So if I pay 20% dividend, it is going to be 40 rupees. What is the price of the share or price of this GDR? How much money have I received? Yes. How much money did I receive or for conversion? Yes. How much will I receive?
1 crore 2 lakh.
I'm sorry. You can see over here, the issue price is here mentioned over here. Are you with me? For price of GDR, this is what is already mentioned. However, there is one challenge over here. And what is that challenge? I want in INR terms. So my price of GDR has to be basically 500 into 90%, yani 450 rupees. But I am also going to have to bear out of that 1 minus 2%. Because I am issuing it for 450 rupees, लेकिन 450 rupees मेरी जेब में जाने वाला नहीं है. How much is actually going to go in my pocket? How much is going to go in my pocket? Only the balance.
98%.
Yes. Only 98% because 2% is your flotation cost. So I'll get 441 rupees. Right? Growth rate is already given to me. That is given 12%. Question has already given this particular aspect, right? So now, what will be the cost of GDR? Cost of GDR will be equal to dividend upon price plus D. Am I right? That comes to 40 divided by 441 plus 12%. So I'm getting 21.07%. Is it understood by everyone? Can I move ahead? Shweta,
Yes, sir.
Priyanka, are you able to follow?
Yes, sir.
Okay. All right. Now, let's take one more small question. Again, this question I will take from the previous session because we have already covered the concept per se of all the questions. So that is the reason I'm repeating those questions so that it helps you in revising it better. Right. Visible to everyone? All right. All right. Let's start question number 2. Messrs. Raghu is interested in expanding its operation and planning to install manufacturing plant at US. It requires 8.82 million USD net of issue expenses flotation cost to fund the proposed project. GDRs are proposed to be issued to finance this project. Estimated flotation cost of GDRs is 2%. Additional information: expected market price of share at the time of issue of GDR is 360, face value 100. Each GDR will represent 2 underlying shares. The issue shall be priced at 10% discount to the market price. Expected exchange rate is INR to USD is 72 rupees. Dividend is expected to be paid at 20%, growth rate 12%. And you as a financial consultant are required to compute number of GDRs to be issued and cost of the GDR. What is your suggestion if the company receives an offer from a US bank willing to provide an equivalent loan with an interest rate of 12%? How much company can save by choosing the option as recommended by you? All right. So first part is something which we have already done in question number 1. I would request all of you, take out your calculators, start solving this particular question and please provide the answer to me. Try, jaldi. Please try.
So gross amount of GDR is 90 lakh, 9 million.
Coming to 9 million. Yes. Then issue price. Issue price is 360. What is the discount we are offering? 10%. We are offering 10% discount. Yes. So how much will that work out to? Again, is it coming to $9?
Sir.
Is it coming to $9?
Yes, sir. It is coming 9.
Okay. So how many number of
Number
GDR?
of GDR is 1.
1 million, right?
Yes. Yes.
1 million units or number, right? These are all, this is amount in million. This is issue price per GDR. All right. So now cost of GDR for me is how much? I'm going to issue dividend of 20, so that is 40 rupees. Yes. Here also will remain same. Here the changes.
Yes, same.
So that will come to
635.05.
635.04. And then you have 12%. So is it 18.30% which we are getting as answer?
Yes, sir. 18.30%.
Now, the second part of the question is, what is your suggestion if the company receives an offer from a US bank willing to provide an equivalent loan with an interest rate of 12%? Now, the cost to me is 18.30. So if somebody is giving me 12% loan, should I accept it? Definitely, I will accept it because it will save me money.
Yes,
And how much company
Yes.
can save by choosing the option as recommended by you? 18.30% minus 12%. So it can save 6.
minus 12.
Right?
6.30%.
Yes. Okay. So this was basically about how to issue funds using ADR, GDR, and computing how much will be the amount and cost. Now we go into the second part of this particular module, which is going to be important aspect, because when you are doing capital budgeting, you will need to convert the currencies from one currency into another, right? So how do I go about doing that? All right. So what are the approaches which are available to the client? So approaches to evaluate overseas projects, right? So I have two approaches which are available to me. First is known as home currency approach. Yani, what does that mean? Domestic currency, local currency approach, right? And the second one is foreign currency approach. So how do I essentially implement them, and what is the difference in these approaches? So what are going to be the steps involved? I'm going to write the steps over here, one against the other, so that you can actually see a comparative difference between the two, right? So say step one is estimate cash flow in foreign currency. Step two, estimate future exchange rates using parity theories. Now, as I mentioned, what are the parity theories? You have two parity theories, right? Purchasing power parity or interest rate parity, which we have learned in module 10. Next is convert future cash flow. Convert future cash flow in home currency. And then you have step 4, discount these cash flows which we have found, right, in step number 3 using domestic required rate of return. In other words, your cost of capital, right? Required rate of return. Are you all with me on that? What is going to be the difference in foreign currency approach? It is going to be because you are going to do everything in a foreign currency basis. So obviously, I will have to estimate cash flows in foreign currency. So same step over here. There is no change over here. Step number 2, convert domestic required rate of return. Domestic required rate of return into foreign currency, right? Into foreign currency required rate of return. Third, discount these foreign currency cash flows. You see the steps over here. They are coming very similar with one change. Instead of home currency, now I am going to do predominantly everything in foreign currency. So I have foreign currency cash flows using the FC required rate of return, right? Computed in step number 2 over here. And then you compute net present value, because that is what is the overall objective for a capital budgeting process, right? The NPV is positive, we accept it. If NPV is negative, we reject the project, right? Now convert after everything is done. You have calculated NPV. Now convert NPV to domestic currency. Domestic currency using which rate? Using your forex rate, right?
Spot rate.
Yes, using your forex spot rate. So here in the first one, you do the calculation by converting everything into, convert your foreign currency cash flows into your home currency. And once you have done that, then you apply your normal discounting rates In the foreign currency approach, first, obviously, you will have to estimate cash flows in foreign currency, but then you convert your domestic required rate of return into foreign currency required rate of return. You discount the cash flows, find NPV over here, and then the final NPV is converted to domestic currency using spot rate, right?
So in the home currency approach, we do the conversion in the third step.
In the
Third step.
in home currency approach?
Yes, sir.
Yes. Convert future cash flows in home currency. That is done in step number 3 in home currency approach. Because once you have found the future exchange rates using parity theories, then you are in a position to convert future cash flow into home currency. Right? So let us take one example again. This is also an example which we had solved earlier when we had previous session in the regular sessions, that is. Let me again. Let me take question number 8 from here. This question was asked in an examination earlier. Right. So from that we have adapted over here. Take that question over here. Visible to everyone? Now, while we are solving, we'll be solving basically a bit further below. So as a result, it is quite possible you might not be able to see this question. So if you want, you can take an image or maybe even a photo of this one on your mobile phone so that you can refer to it, right? As we start solving the sum. So DK Limited is considering an investment proposal in Sri Lanka involving an initial investment of Lankan rupees 25 billion. The current spot exchange rate is INR to LKR is 0.37. Now remember, the quoted currency or the base currency is LKR over here, right? INR upon LKR is 0.37. So you are expressing LKR in terms of INR. So you pay 0.37 INR to get 1 Lankan rupee. The risk-free rate in India is 6% and the same in Sri Lanka is 5.20%. The project will generate a cash flow of Lankan rupees 5 billion in the first year. Cash flow will increase by Lankan LKR 1 billion each year for the next 4 years, meaning 5, 6, 7, 8, 9. Right? Project will bind up on completion of 5 years with no salvage value. The required rate of return for the project is 8%. You are required to find out the investment worth of the project by home currency approach, foreign currency approach. Compare the outcome under both the approaches. What we are given is the discount rates are given to us. Discount rate at 8% and 7% respectively. Now they were given 8%, that is understandable. The required rate of return is 8%. Why have they given 7%? Any chances? Any ideas? Yes, any ideas? Why they have given 7%? Is it clicking to anyone? Why 7%? Because the risk-free rate is 6% and 5.20% as such. So why 8%? Sorry, why 7% now? 8% का दिया है values. Is it just additional information? We don't know as yet. When will we come to know? When we convert this required rate of return of the project, which is 8% in Indian terms, we will convert it into your foreign currency approach, right? That's when we will come to know if there is a different rate going to be there and if that rate is going to be material over here, right? So let's proceed further. First and foremost, I would need to do calculation of foreign exchange. So how do I go about doing calculation of foreign exchange? Which method am I going to use over here? Am I going to use purchasing power parity or am I going to use interest rate parity? Which information is available to you? The information available is interest rates, right? 6% and 5.20%. So I'm going to use over here interest rate parity to find the rates of returns in future period. All right, let's start. So first and foremost, I'm going to do calculation of foreign exchange rates. So how do I go about doing calculation of forex rates? I'll do it in Excel. Is it okay? Is it visible to everyone? Because then I will not have to do the calculations on calculator over here. Unless somebody is carrying calculator and you can do it, then you can give me the numbers I can do. What is better? Yes, Priyanka, what will be better? Should I write or should I type it in the Excel? How would you prefer it?
Type in Excel, sir.
Type in Excel? Okay. So I'll type it in Excel in that case. So first and foremost, let me select the entire thing, make it. Okay, all right. So now, let's start. First of all, I'm going to start with calculation of foreign exchange rates. Okay, so how many hours here? 1, 2, 3, 4, 5. So I need to find over here what is the exchange rate rupees per LPR. So how am I going to go about computing it? What is the existing rate which is given to you at the beginning of the very first year? The existing rate which is given to you is, let me take this. For 0 year, what is the rate currently? Is 0.37, right? This is given in the question. This is given in the question. So what will be the new rate? New rate will be 0.37, right, into. Now, please note, what is the rate which is mentioned over here? It is rupees, Indian rupees upon Lankan rate, right? So I'm going to essentially multiply that with 1.06 divided by 1.052. What am I doing over here? I am essentially incorporating the interest rate effect over here, right? I am essentially incorporating the interest rate effect over here. So you can see in the numerator, I have Indian rupees, and thus risk-free interest rate of India is taken in the numerator when I am multiplying 1.06, and in the denominator I have taken the Lankan rate, because that is how the currency rate is being expressed over here, rupees upon LKR. So I am also following the same thing when it comes to my interest rates. Are you with me?
So what is this 97?
E97? E97 is, let me put it this way, 0.37. Does that work better now? This 0.37 existing forex rate.
Yes, sir.
At the beginning of the first year, right? So it is year 0. The beginning it is 0.37. So at the end of the year, क्या हो जाएगा rate? Getting it? Now all I need to do is take the previous rate into 1.06 divided by 1.052. I'll need to keep repeating the same process again and again. And I will get the exchange rates for the 5 years. Getting it, everyone? These are my new forex rates. All right. Now we will start with, first of all, home currency approach. Home currency approach. So I'll have my first column obviously has to be years. How much is going to be my cash flow? Cash flow in billions of LKR, right? Cash flow is billions of LKR. How much is the cash flow? What is being told to us? Please read the question again. It says project will generate a cash flow of LKR 5 billion. In the first year, the cash flow will increase by LKR 1 billion each year for the next 4 years. So it is going to be 5, increasing by 1 billion each year. So 6, 7, 8, and 9. That is like that. What is my forex rate? Rupees upon LKR. So I found already what is my rupees upon LKR forex rate. Already here for the 5 years. That into the copy paste where I will say values only. Remember, I am doing it in Excel. You are doing it on pen paper. Should not get too emotionally invested and start taking 4 or 5 decimal points. At best, take 3 decimal points, or even if you take just 2 decimal points, that is also okay. I am keeping 3 decimal points just to prevent any mishap because the amounts are in billions. So I am trying to take 3 decimal points to be on the safer side. Now I have to multiply cash flow. Why? Because what is my home currency approach? What is my home currency approach? Methodology. Estimate cash flow in foreign currency. So I have already estimated that 5, 6, 7, 8, 9. Step 2, estimate future exchange rates using parity theories, which I have already done. Right? So that also, step 2 is done. What is step 3? Convert future cash flow in home currency. So now I have to convert this cash flows into INR, right? I have to convert this into INR. How do I do that? How much will be the rupees? Per Lankan rupees, I get 0.37. This is 5. So should I just multiply this rate? Because per Lankan rupee is 0.373. This is 5. So can I just multiply them? Yes. Do I need to multiply or do I need to divide?
Multiply.
I need to multiply, right? Alright, now I need to discount these cash flows at 8%, which is the required return for me. So I am already being provided with the PV factors. I don't need to work on finding them. It's already given in the question. So you can see over here on the screen also, it is 0.9259, 0. Now here, since you are given 5 decimal points, please do not take shortcuts over here. Huh? you will need to have to take all the 5 decimals. Otherwise, your answers will not match, and then you cannot hold it against the examiner saying that मैंने तो ये सही किया था. Examiner will be in his rights to then in that case deduct your marks. Now I have the PV factors available. All I need to do now is find present value of cash flow. Billion INR. Yes. So how much does that turn out to?
1.7260.
Yes. All you need to do is multiply PV factor with cash flows. Since I've taken 4 decimal points over here, I'll keep it till 5 decimal points over here. This is 4, PV factor was 4 decimal points.
Yeah.
So I'll keep it till 5 decimal points. Which I'm getting is 10.35808. Now, compared to my answer, probably your answer will be slightly different. Why is that so? Because if you see over here, when I've taken these rates are, you see these rates, it's coming to a whole decimal, right? While in your examination, obviously, when you will be writing it, it will be only 3 decimal points. So as a result of that, that rounding off challenge is going to be there. So right now you will have that difference between my calculation and your calculation. So I believe you should be getting something like 10.37, something like that. Are you getting that? No. Okay. Now let me take this Control C, put it over here. Answer is changing. You see that? Okay. Less, I have to find NPV, remember? So less, what is the investment I will have? What is the investment I'm going to have over here? I have investment of 25 billion, right, in LKR terms. So it is 25 billion LKR, and I have to multiply that with the current spot rate, which is 0.37.
9.25. 9.25.
9.25. Very good. So I get 10.35 minus 9.25. So it is coming as 1.10951. Is everyone getting this? This is NPV which is rupees in billion. Okay. INR NPV है. This is my home currency approach. Now, since in the examination, we are in this particular exam, we were asked, or this question, we were asked both the methods. So now we will also use foreign currency approach. All right, now let's start with foreign currency approach. Now, before I start with foreign currency approach, I need to, first of all, before I start estimating, I will need to convert domestic required rate of return into foreign required rate of return. Now, you might say, sir, why going into step 2 and not step 1? Please check over here. Step 1 is same, right? Have you already done step 1? Yes, we have already done step 1, right? 5, 6, 7, 8, 9. That I already know. So now I want to go to the step number 2 directly. Convert domestic required rate of return into foreign currency required rate of return. So how would I do that? How do I do that? Now, you are told over here that your risk-free rate is 6% in India, right? Which is the home currency. So you have to convert your domestic required rate of return into foreign currency required rate of return. So required rate of return basically has 2 elements to it. What is that? RF plus risk-free rate. What is? How do you get CAPM? Do you recollect? Capital asset pricing model. How do you calculate your required return? It is RF plus beta into RM minus RF. Am I right? Risk-free rate plus beta into RM minus RF, which basically means RM minus RF is nothing but risk premium, right? So when my economy is expected to grow risk-free at 6%, and you are expecting required return is 8% in domestic terms, so what is the by default risk premium which we have incorporated in the domestic currency terms? Why am I going to calculate?
Sir,
Yes, please.
8 divided by 6 into 5.2.
B.
8 divided by 6.
Hmm.
Required rate of return divided by risk-free rate in India into risk-free rate in LKR.
Very good. So how much would you get?
6.933.
So what we are doing over here is you are taking 8%. Hello?
Divided by 6%.
8% divided by 6%. Okay.
Into 5.2.
Into 5.2. Okay. Now,
Yes.
can I directly multiply percentage like that? Let me put it this way.
Is this correct or not?
Let us find out. Is this the right way to go about it? How do we go about it? Whatever percentage we are saying, 8%.
8% is required rate
Yes. So I am
of
saying
project.
my required rate of return for the project is 8%, meaning I am saying it has to be 1.08. Am I right? At the end of the year, I expect it to be 1.08. And risk-free rate is 1.06. Are you with me?
Yes.
Now, logically speaking, what this means is one basically is your main value, right? Assuming rate of returns are same, then in that case, 1 would have been equal to 1. So here, when we say 1.06, it is basically supposed to be what? 1 plus risk premium. Am I right?
Yes.
So if 1 plus risk premium, when I say is 1.06, so then how much will be your risk premium turning out to be? How will you calculate that? Now, as you mentioned over here, let's say this is 1.08 upon 1.06. How much will this turn out to be? Yes, how much will this turn out to be?
1.018.
1.0188.
1.0188.
88.
Okay. So 1.0188. So when I take this over here, what is happening is basically I am discounting it with the risk-free rate. Now what is remaining is the risk premium which I have incorporated in my required rate of return. So here it's not a simple 8 minus 6 which becomes your premium. The premium percentage per se is what? What is the premium percentage per se which you have incorporated is? It is 1.08 upon 1.06. So effectively, what becomes is 1.0188. Now, 1 is my principal value. So when I subtract 1, what is the risk premium I will get? Risk premium in I
0.0188.
is equal to 0.0188,
0.
right? 188 percentage. Now, this is my risk premium in INR terms. Are you with me? Okay.
Yes, sir.
So now if I have to find in Lankan rupees, so how will I calculate my required rate of return in Lankan rupees? How do I do that? I will say
Then
this becomes 1.0188 होता है ना मेरा INR में. So I will say that has to be multiplied with 0. That has to be multiplied with. यहाँ पे हमने देखो डिवाइड करते वक्त 1.06 से किया था. So I will also multiply it with 1.052 because it has to be calculated on 1 plus risk-free rate, right? Are you with me? I repeat once again. So 1.08 is my required rate of return, while 1.06 is my risk-free rate because 6% is the risk-free rate. So if my principal was to grow by 6%, it will become 1.06 at the end of the year. So there are two ways of going about it. Now I have done it in 2 steps. What you can also do is directly, as you were yourself saying, you can also do directly 1.08 upon 1.06 into 1.052. You can directly do this also. However, what you were suggesting earlier, that sir, let's take directly 8% upon 6% into 5.2%. This will not be right. Why? Because the proportional effect of your principal will be lost over here. Are you with me? 8 upon 6 will turn out to be 1.33, which will essentially give you a misleading impact. You have to essentially understand it is not 2% which is growing on 6%. What is growing is there is 2% growth over 106%. Are you with me? This is the point at which a lot of the students make a human error. Because you have to understand, I am not getting 2% on 6%. Because this, it appears, this calculation, as you had identified earlier, what this says is you are getting 8% instead of 6%. So you are actually getting a growth of how much? Almost 33%, right? Which is wrong. So you need to essentially incorporate the principal element into it and say at the end of the year, 1 will become 1.08 divided by 1.06. So then you will get the real proportionality effect of 1.0188, right, into 1.052. So how much will this rate now come to? This is my required rate of return in LKR. Are you all with me? Is that clear to all of us?
Yes, sir.
Okay. So
Yes,
कितना
sir.
आ रहा है ये amount?
1.07184.
1.0718.
184.
1.08. 1.0718. That means it is 7.18%.
7%.
Now we will take over here approx 7%.
7%.
Why I will take 7% and not 7.18? There is an implied guidance which is given to you in the question. Which is that guidance?
PV factor 7 का level.
The factor at 7% was given, right? That is the reason we are going to take it at 7%. Otherwise, we would have taken it at 7.18% itself. Okay? All right. Now that I have the numbers available with me, so let me start solving it. So just like foreign currency approach, now I'm going to do with home currency approach. All right. Foreign currency approach. So I know my year, I know cash flow billions. Remember, I will not need to convert this at this particular point, right? I don't need cash flow billion INR at this particular stage. So what I need is total this over here will be at PV at 7. That 7% are the rates given to us in the question. Yes, 0.93457. 0.93457. Then I have 0.87344. 0.87344. Then what?
0.8163.
81630. Then
0.76290. 0.76290.
0.6290. And then 0.1
71299.
99.
299.
Okay. How much is the investment over here? It is in Lankan rupees, so it will come 25, right? This is PVCF in LKR. we converted and calculated everything in LKR. My NPV in Lankan rupees is coming to 3.14770. Now NPV will have to be converted into INR, right? So let's convert NPV into INR. NPV in INR will be how much? At the spot rate, right? This into 0.37. Am I right? Spot rate is 0.37.
Into what?
Should it be into or divide? What should I do? Into करूँ, divide करूँ? So the rate
Sir,
given.
divide होगा. Divide.
डिवाइड होगा. चलो इधर सिंपल सा कैलकुलेशन करते हैं भाई. आप मुझे बताइए. आंसर तो आप ही को देना है मुझे. So INR LKR. This is 0.37 per Lankan rupee. And PV is 3.14770 LKR. So how much of INR? Yes. क्या करूं? 3.14770 multiply करूं या divide करूं 0.37?
Multiply.
Multiply.
Will be into 0.37 upon 1. Right? So how much is that coming to? That comes to 3.14770 into 0.37. 1.1646 in INR. पहले होम करेंसी अप्रोच में कितना आंसर आया था? 1.10. So due to my rounding of etc. generally थोड़ा डिफरेंस आपको आएगा, right? Because you are calculating the entire NPV and then you are taking the spot rate today, right? मिला सबको ये आंसर मिला?
Yes, sir. Yes.
Okay. Question में क्या पूछा था? What was asked in the question? You are required to find out the investment worth of the project, right? So we did that, and thereafter we are asked compare the outcome under both the approaches. So what is the outcome under both the approaches? NPV is positive in both the approaches, but NPV under foreign currency approach is higher compared to NPV under कौन सा मेथड?
Foreign currency.
Foreign currency.
So foreign currency approach is NPV under foreign currency approach is higher compared to home currency approach.
Home
But it's a
currency.
marginal gap, remember? Very, very marginal because of the rounding up, etc. But both are positive. So we have done the comparative. Now, are we all through? Are we all through? It's getting to half time. So we will now initiate a break. But before we go to the break, what have we covered today? What did we cover today? Very fast recap. We started with international financial management. It is financial management, but the moment we say international, it means foreign exchange is involved. If foreign exchange is involved, you have forex risk involved. Political risk across the borders comes into picture, right? And then you will have export cannibalization, which may happen because the moment you set up or outsource anything which is to another entity, your existing sales will get adversely affected. Why? Because maybe your new sale will essentially eat into your existing sale. This happens even with a lot of the new products which are being launched. For example, when iPhone 16 comes into being, people obviously will not buy iPhone 14 then, they will start buying iPhone 16. So effectively what is happening is 16 is essentially eating into the market share of 15. People who would have otherwise bought 15 now are buying iPhone 16, right? So that is cannibalization. Of course, in this case, iPhone or rather Apple is having a conscious decision. They want to keep upgrading it in such a way that people automatically feel that my phone is getting obsolete and they will keep on buying the new one to keep themselves updated. All right. Thereafter, in financial management, what are the most important questions which we need to address, or rather the businessmen will have to address? So those are financial management. So how to raise funds, ADR, GDR or FCCBs, that is fully convertible, foreign currency convertible bonds. You have Euro issue. You have American depository receipts or global depository receipts. We solved a couple of sums on this. Then we started with capital budgeting. In capital budgeting, obviously, you will have foreign exchange coming into play and you will have to convert your one currency into another using either purchasing power parity or interest rate parity. We solved one sum just now on this as well, right? The other two situations are where you need to essentially take care of working capital management, where you may do netting or treasury management. And fourth is your dividend decision. Okay. So this is where we have reached so far, and we did a comparative study of home currency approach and foreign currency approach. We will do one more sum on the assignment which I have shared for the today's session, reversionary session today, right? So we will start with that after the break. Right now, we will take the break of 10 minutes and then we will start. Okay. Ashokji, can we take a break of 10 minutes, please? All right. Thank you. We will take one more question, which I had shared in the assignment to all of you for today revisionary lecture. For those of you who may not have that question, I am going to copy paste that question over here for easy reference. Okay. Let me just arrange it in a format so that it will be easy for everyone to see. Okay. All right. I believe now the question is readable for everyone. Is it visible to everyone? Yes, this is a question which I have already shared. We have uploaded that also. Let's solve this particular question. Is it visible to everyone?
Yes, sir.
All right. Let's start. A USA-based company is planning to set up a software development unit in India. Software developed at the Indian unit will be bought back by the US parent at a transfer price of US dollar 10 million. The unit will remain in existence in India for 1 year. The software is expected to get developed within this time frame. The US-based company will be subject to corporate tax of 30% and a withholding tax of 10% in India and will not be eligible for tax credit in the US. The software developed will be sold in the US market for US dollar 12 million. Other estimates are as follows. Rent for fully furnished unit with necessary hardware in India, 15 lakh rupees. Manpower cost, 80 software professional will be working for 10 hours each day at rupees 400 per man hour. Administrative and other costs, rupees 12 lakhs. Advise the US company on the financial viability of the project. The rupee dollar rate is 48 per dollar. Assume 365 days a year. Now, before we start, very important for us to understand one concept. Here we are essentially touching upon is it's mentioned for transfer pricing, right? US parent at a transfer price of US dollar 10 million. So, what basically this is going to mean for us? So, let us first of all understand. Now, what the transfer price concept is based on is that there should be an arm's length pricing between the two. At the same time, Indian government obviously do not want to lose their rightful revenue. If you are going to manufacture something over here, say for example, if the cost is 50 rupees, which can be, let's say 50 rupees, which can be sold for 200 rupees, which means there is a profit of 150 rupees. But because you are doing it within your own undertaking and organization, now because India is charging you 30% tax, say for example, you are in Dubai right now. Okay. Dubai does not charge any tax, for example, 0%. So then you would say you are essentially transferring this 50 rupees to Dubai at 50 and thereby not pay any taxes in India. In order to avoid this, transfer pricing regulations comes into play, which says there has to be an arm's length pricing, right? So now you, even if you want to sell it to your own entity in Dubai, you sell it at not 50 but at 200, which means the profit of 150 will be offered for taxation in India. Once you have paid the taxes, after that, if the money is allowed to be repatriated, you can even take the balance money out. Okay, I repeat the concept. My cost is 50 rupees. Normally, I would have been able to sell it for 200, and that is what the Indian government through transfer pricing regulations tries to protect, that the sale value of this particular work is 200 in the independent market, which is arm's length pricing market, right? So even if you're selling it to your own entity in Dubai or parent entity in Dubai, you will sell it at 200, thereby booking a profit of 150 rupees in India, and then you have to pay 30% tax on that profit. Balance money, if it is allowed as per the FDI policy, you may repatriate the balance money back to Dubai, your parent or wherever you want to send it, right? Now, on that same concept, this entire question is based. So, how does this particular question work over here as far as the numbers are concerned? So, you are told that you are going to be manufacturing something which is going to have a certain cost. Okay, certain cost is there. Say, for example, that cost is whatever, 100 rupees. Okay, that 100 rupees cost you are going to essentially spend for the purpose of developing a software. This software you are going to sell it to your parent who is in US, right? Your parent in US to whom you are going to sell this particular thing at the price of $10 million. Now this US parent is again going to sell it to somebody else at US dollar 12 million. That is what is being clearly told to us. Software developed will be sold in the US market at 12 millions for US dollar 12 millions, right? So it will be sold at US dollar 12 million. Now the question which is being asked is, advise the US company on the financial viability of the project. The rupee dollar rate is 48. So you are going to have certain costs. Your corporate tax liability in India is 30%. You will sell it to US for 10 million, and then the US parent company is going to sell it for 12 million. Okay, so let's see how we go about it. So first and foremost, I will need to prepare the entire statement, right, of my costs and revenue. So I start over here with my revenue. Okay, all right. So what is going to be my revenue over here? What will be my revenue? I'm going to sell it for how much?
$48.
10 million, right? $10 million into rupees 48, which is my exchange rate. So what I will have coming up over here is 48 into 10 million. So it will be 480 million. Am I right? 480 million. How much does that turn out to? That is 48 crores. Am I right? Okay, that is my revenue less costs. So which are the costs which I have? First is rent. Rent कितना है? 15 lakh rupees. Is this visible to everyone? Or should I increase the size further? Okay, chalo. All it costs 15 lakhs is rent. Which other cost is there? Then further we are told manpower cost. So manpower cost is how much? Manpower cost is how much? We are told it will be 80 software professionals working for 10 hours each day, where they are getting paid 400 rupees per man hour for how many days? 360. 365 days, right?
1168.
So come to 1138. I'll again add commas to it. 11 lakh Is it 11 lakhs? No, 11 crore 68 lakhs. 11 crore 68 lakhs. Okay, all right. Next, further you are told is administrative and other cost. Administrative and other cost. That is how much? 12 lakh rupees. Right? 12 lakh rupees. So, what is the total cost turning out to? Again, 12 lakhs. 11 crore 95 lakhs is the total cost. So, after deducting that, what we get is we get earning before interest and tax. Am I right? EBI will be 48 crores minus 11 crore 95 lakhs.
3605.
48 crores minus 11 crore 95 lakhs. Yes. So we get 36 crore 5 lakhs. Right. Now further, what are we told? There is
Tax.
tax element on it. What is the tax eligibility? The US based company will be subject to corporate tax of 30% and a withholding tax of 10% in India. Okay. पहले तो withholding tax pay करना पड़ेगा भाई. How much is withholding tax which I need to pay? 10%, right? Withholding tax is nothing but your TDS. And remember, we will always claim benefit of that against into 0.1. So that comes to 3 crore 60 lakh 50,000.
First, will we compute the TDS or the tax?
So we will calculate both, but for presentation wise, we will show them separately, right? So corporation tax as such, you can see over here, I am going to write this is 30% of EBIT, right? Minus withholding tax 10%. So balance will be how much? 20%. Are you with me? Yes. So I am going to calculate now EBIT into 0.2, which is 20%. I am not taking over here 30%. Why? Because you know corporation tax is 30%. So whatever is the amount against that, I can claim credit for withholding tax which already has been paid. Am I right?
Can we do the other way also? Like first we calculate the tax at 30% and then we take the TDS on that.
If you want that way, you can even write directly over here withholding tax, and in the brackets or just below that, you can give the breakup. Withholding tax will be 10% this much and balance tax will be this much. That is also okay. Presentation wise, you have that flexibility, but don't forget the concept, please. Okay. So now 25 crore 23 lakh 50,000 is what is remaining, right? This is the, what is this called? Earning after tax. Am I right? In INR. Am I right? So say for example, if you want to repatriate this money, if you want to amount to be repatriated. Remember software development, so it comes under IT sector and IT is under 100% repatriation benefit, right? You can even have 100% foreign ownership, even for repatriation, you can do it. You don't need any prior approvals for the same. So amount to be repatriated in USD will be how much? It will be EAT INR divided by 48. Are you all with me? Yes. So amount to be repatriated in USD is how much? 5257 to 91.67. Are you all with me? This aspect is very important for me to know that you have understood this, because based on this, I'm going to take the another corollary of it. So what is the total cost of developing software in India? Yes. What is the total cost of developing software in India? Now pay attention, please. $10 million, right, is what you are paying. Now this is the same entity per se, parent company and subsidiary entity. So my subsidiary is going to make this particular software, give it to me at $10 million. So strictly speaking, just because I bought it for 10 million does not mean that the cost for me is $10 million, right? Because out of that, 50 to 57 again came back to me. So what is the net cost of developing the software? The net cost of developing the software is $10 million minus the amount which I have already received, earning after tax, which was already paid out to me. The cost kitna hua mere liye? What is the cost for me in dollar terms? Yes. What is the total cost of developing software in India in USD? Can I say that it is 4742? समझ में आ रहा है? Are you all able to follow? And parent company can sell this in US for USD how much? 12 million, am I right? It's 12 million USD, for which you can sell it in US market. The question which is being asked to us is, advise the US company on the financial viability of the project. Is this project viable? You are making something for $47,42,000 and you are selling it for 12 million, that is 1 crore 20 lakh dollars. Is it viable? Yes? Yes or no? Yes, we should.
Yes.
For development software in India. Got it, everyone? Got it, everyone? All right. Now, let's take one more question. Let's take one more question, which again, I have already done it earlier. So I'll take the question from there. We had solved this question earlier in the regular sessions. All right. Is this question visible to everyone? This is also one of the exam questions which was asked formally, which we had solved earlier as well. However, I feel again this will be a good practice for all of us, right? So, a US company wants to set up a manufacturing plant in India which requires an initial outlay of rupees 8 million. It is expected to have a useful life of 5 years with a salvage of rupees 2 million. The company follows straight line method of depreciation. To support additional level of activity, investment would require one-time additional working capital of rupees 1 million. Since the cost of production lower in India, the variable cost of production would be rupees 30 per unit. Additional fixed cost per annum is estimated at rupees 0.5 million. The company is projecting its annual sales to 80,000 units at the price of rupees 100 per unit. Applicable tax rate to the company is 34% and its cost of capital is 8%. Inflation rates in US and India are expected to be 8% and 9% respectively. Current exchange rate is 72 per US dollar. Assuming that all profit will be repatriated every year and there will be no withholding taxes, estimate the net present value of the proposed project in India and evaluate its feasibility. PV factor at 8% for the 5 years are as under. Okay. All right. Now, what are we supposed to do? We are supposed to find whether this is a project which is viable or not based on the required rate of return. Okay. So, what is going to be the initial investment over here? Yes. What is going to be the initial investment over here? We have an initial investment of rupees
8 million.
8 million, that is 80 lakh rupees. Plus, we will have additional working capital required, which is, you can see over here, additional working capital required. So that will be 1 million. So my total investment is going to be 9 million, right? Now, exchange rate prevailing is 72. So at that particular rate, we can calculate what is initial investment in US dollar. Okay. Once we have that, can you calculate expected exchange rates over here? Can we calculate expected exchange rates over here? We have done that earlier, remember? In the home currency approach. How do we convert that? Using, for purchasing power parity, you need inflation numbers. For interest rate parity, you need interest rates. Do we know the inflation rates or interest rates over here? What is given to us? Inflation rates or interest rates? Yes. Inflation rates are given to us, so that we will be using purchasing power parity principle, right? And we will find the exchange rates using that. Once we have done that, then we will calculate our annual cash flows. And after calculating annual cash flows, we will also calculate then the present value of cash flows. Chalo, shuru karte hain. Let's start. Let me start solving some part over here. Next to it, it's
Hello.
Priyanka.
Ippada.
All right. Let's start. Okay. So first and foremost, what is the investment? This is so what is my initial outlay? Initial outlay is, amount is how much? 8 million. That is it 80 lakhs? Does 8 million mean 80 lakhs? Yes or no? 6 zeros, right? It is 1 million is 10 lakhs.
Yes, sir.
Okay. Add additional working capital. How much would that come to?
10.
10 lakhs or 1 million. So I have total outlay of 90. If you convert that into dollar, initial outlay in USD will be how much? To be 90 lakh divided by spot rate today, 72. Are you all with me? Yes.
Yes, sir.
All right. So this is my original investment. Now I start with expected exchange rate. How will I get my expected exchange rates? Yes. 5 years. I'm going to calculate my exchange rates. In fact, I start over here with 0. Right? So rupees per USD कितना है to start? Starting में 72 rupees है ना? Given है ना question में 72 per USD. So how will you get it for subsequent years? You will have to incorporate what? Inflation. Now tell me, should I take the inflation? Meaning, inflation we are told कितना है? Inflation rates in US and India are expected to be 8% and 9% respectively. So should I be multiplying the 72 with into 1.08 upon 1.09 or should it be into 1.09 upon 1.08? So here you have to multiply with, you have to multiply with, you can look at the exchange rate over here, rupees upon USD. So the number which is in the numerator, you will take that inflation number in the numerator, 1.09 divided by 1.08, right? You have to multiply 72 over here with 1.09 divided by 1.08. So I will get the exchange rate at the end of the year 1. Is it clear and understandable to everyone? So I get the exchange rates. So I've got the exchange rates now for the 5 years. Now let us work on the cash flows now. I've got the exchange rates. Now let's work on the cash flows. Annual cash flows. What will be my sales? I'm going to sell how many units?
80,000.
80,000 units. We are told over here. You can see over here, its sales is 80,000 units at 100 per unit, right? At 100 per unit. So that turns out to be 80 lakhs. Okay? Less. We will say what? Variable cost. What is the variable cost? Since the cost of production lower in India, variable cost of production would be rupees 30 per unit. So you have variable cost of 30 per unit.
24 lakhs.
So it will be equal to 80,000 units into 30. Right? Into 4 lakhs. Any other cost? You also have additional fixed cost, right? Additional fixed cost is also there. How much will be the additional fixed cost?
0.5 million.
0.5 million. That is 5 lakhs. That is 5 lakhs. Then I have to also calculate depreciation. Depreciation is going to be how much? How much will be my depreciation? Yes. I am going to invest 8 lakhs, right? Or 80 lakhs. How much is that I am investing? 8 million बोला है ना आपको? You told
80 lakh.
8 million on the very first line. So
80 lakh.
80 lakh rupees is what you are going to be investing. And you are going to have some salvage value coming out of it at the end of the period. What is the salvage value? 2 million minus 20 lakhs divided by how many number of years? What is the life of the asset? 5 years. So my depreciation is going to come up as
12 lakhs.
12 lakh rupees.
$39 lakhs.
39 lakhs. So total now what I get is earning before tax, right? Earning before tax. How much will be my earning before tax? 80 minus all the cost, right? 24 minus 5 minus. So I get 39 lakh. Earning before tax is 39 lakhs less. How much is the tax rate over here? Are we given anything about tax? Applicable tax rate to the company is 34%. This is 34%. 34%, 39 lakhs into
13 lakh 26,000.
13 lakh 26,000, right?
Yes, sir.
So what is now my earning after tax?
25 lakh 74,000.
Earning after tax 39 minus 326. So I get 25 lakhs 74,000. For calculating the cash flow, do we add the depreciation back? Because it's a non-cash expenditure.
Yes, sir.
So let's add depreciation. How much is that? 12 lakhs. So my cash flow will be 25 plus 12. So I'll get 37 lakh 34,000 plus 37 lakh 74,000 as cash flow. Now I will essentially utilize the exchange rates which I have. I have the same annual cash flows year on year, but exchange rates are changing, remember? So I'll have to multiply my cash flow with the new exchange rate to find out how much is the US dollar. Because we are specifically told over here in this question that profits are repatriated. It was mentioned over here, right? Assuming that all profit will be repatriated every year. It's told to you over here clearly. Assuming that all profit will be repatriated every year, right? And there will be no withholding taxes. So now I need to calculate how much is going to be the total amount which is going to be repatriated to US, and then we will compare with the investment to find the final number. Yes. So let's prepare the statement of amount repatriated to US, right, in dollar. I have calculated everything in INR so far, so I will use exchange rates for here. 1, 2, 3, 4, 5. Okay, all right. What will be the cash flow in INR? Cash flow in INR क्या होगा आपका? 37,74,000 is your cash flow, right? For all the 5 years, you are going to get the same cash flow. $37,74,000. Now, for repatriation every year, I will need the rates which are applicable, right? So I will say essentially I want the exchange rates. What is my exchange rate for the 5 years? Exchange rate I have over here for all the 5 years. 37,74,000.
What did we multiply 37,74,000 with?
I'm sorry, my dear.
What did we multiply 37,74,000 with?
So 37,74,000 is INR, right?
Yes.
And you want to convert that into dollars. So will you multiply or will you divide now? If ever you have that doubt,
Divide.
follow a very, very simple concept which I have shown you earlier also over here. ज़्यादा tension नहीं लेने का. Don't tense yourself simply. Just follow a very, very basic principle which we have been doing all the way since our schooling as such. Rupees and dollar, right? Rupees is, say for example, 72, dollar is 1. Now I am told 37,74,000, right? So how much will be the dollar? How will you get that? By cross multiplication, right? So it will be 37,74,000 into 1 divided by 72. Then I will be able to find this. So here
Right.
division. So all
Right.
these rates will have to be in the division. So 3774 divided by this, Right? Are you all with me? Getting
Yes.
it?
Yes.
Okay. Now I have 2 more things to be identified over here. So let me first of all take my low-lying fruits first, since we have already worked on it. So let's complete that first. Right? So this repatriation in USD. That will come to how much? 3774 divided by the exchange rate. Okay. So I am getting 51,935.78. Is everyone getting that? Yes. There are two things which are further going to be released, right? What is that? What are you going to get additionally at the end of the fifth year? There are two things which you are going to get over here released. What are those two things? I will not need my machinery any further, so I am going to receive something known as, what is that?
Salvage money.
Exactly. We have already accounted for that, right? When we were calculating depreciation. So now this money obviously has to be received back, which is 20 lakhs, 2 million, right? So this money has to come back. Further, also, one more aspect will get released. And what is that?
One-time initial investment. Working
Yes,
capital.
one-time initial capital investment in your working capital, right? We had invested 1 million. So now that 1 million will be obviously get released back because now you are not going to have this particular project any further. Are you with me? So far, so good? Yes. Now
Yes,
it is
sir.
quite possible in your calculations on your in pen paper mode. We will take only rupees USD. Since here we are given 72 rupees, we will take at best till 2 decimal points or 3 decimal points. Don't go beyond that. Okay, don't get emotional. I have Excel, so obviously I'm able to do drag and drop. That's a different thing. But for examination purposes, you can always take up to 2 or 3 decimal points max. All right. Now this is my repatriation, which is going to happen to me in 5 years in USD terms. This is cash flow in absolute terms we have taken. We need to consider the present value, isn't it? We need to incorporate this PV factor at 8% return because only then will I be able to essentially compare the receivables with the outflow and identify what is the NP. So I will now use over here my PV factor at 8%. PV factor at 8%, 0.926. These are all given in the question. I am not creating these numbers. 0.794, 0.735, 0.681. Now remember, the salvage and working capital is also coming at the end of fifth year. So it will have 0.681. So now, what will be the present value of cash flow in dollar? Now I will say 51 repatriation into PV factors, right? Total inflow is how much? This is my total cash inflow. My total cash inflow less initial outlay in dollars. What was my initial outlay in dollars? We had calculated earlier. What is my initial outlay in dollars? We had calculated earlier. You can see over here, we had calculated 1,25,000, right? So I will bring that 1,25,000 25,000. So now I have NPV which is positive 105,993. If you have $15-20 aage piche, don't worry. It is all because of your rounding of decimal differences. No worries whatsoever. What was the question being asked? Assuming that all profit will be repatriated every year, there will be no withholding taxes. Estimate the NPV of the proposed project in India and evaluate its feasibility. Yes, so what will be my decision over here? You have to give the decision, and please don't forget to give your decision, otherwise you will lose 1 mark. 1 to 2 marks may be assigned only for the decision. So since NPV is positive, what should we do? Should the project be accepted? Project
Yes,
should
sir.
be accepted, right?
Feasible.
Accepted or rejected?
Accepted.
Project should be accepted. Normally, when I set the papers or any exam question, I always put 1 or 2 marks for this final decision, because a lot of the times, even for good students who have got the entire answer correct, they have this particular thing, they leave the last judgment or the decision part, the conclusion part, without writing that, they just go into the next one, right? And that is very, very important. You need to conclude your project report. So you have that particular recommendation.
So even if some of the calculation is wrong and the final answer is correct, so we get those 2 marks for that final answer?
No. Then in that case, you will not get the marks just for writing NPV is positive or NPV is negative. It is quite possible, for example, your NPV is 1,05,000 and your answer may be 55,000. So you are almost 50% off, right? And then you say, sir, decision to same hi hai, NPV is positive, can you please give me the marks? Then it will not be getting the marks, right? However, having said that, for the process, what you have done, and each step by step generally marking is there, right? You have seen the suggested answers.
Yes, sir. Yes, sir.
Credit are generally given by that, but it also depends on what you have done, how much you have clarified each element. That is very, very important. So that is the reason, if you are getting, like, for example, there are some students who are really very intelligent, and what they do is they essentially omit a step in between the examination, because they believe this is automatically getting reflected over here. But when they go to the next step, there they are making a mistake, and as a result, there is an error. So now you can't get marks for that particular step, and also for the previous step, because you had assumed that you will get it or you will cover that particular aspect in the next step. You have not done that. So you essentially make that error, and as a result of that, your risk increases, right? So you will not get the marks for this step also and the previous step also, because you have not done previous step. Next step, you have made a mistake, so you will lose there as well. So try to minimize your risk when you are writing an examination. Ensure that, for example, the way I have essentially gone about. Now, for example, a lot of the students, or even in the suggested answers, you will find that amount repeated in US dollars is mentioned one. Then they are making a separate table for calculating present value of cash flows, right? They're making a separate table for it. I have not made a separate table. So you can work on this particular efficiency part, because ऐसा नहीं है कि 2 table करोगे तो ही marks मिलेगा. But that efficiency has to come in for you in the examination. So I don't have to write the same thing year 1, 2, 3, etc. again and again. So mentally, if you have practiced, then obviously you will be able to express it better, because then you know essentially what is my final destination, where I want to reach, how I want to essentially present it. So please practice as much as possible, right? I have had friends, because remember, I myself am also a CA, I have done it long back, but lot of my friends, my students also have this, some of these students have the habit where they can't essentially practice everything, right? So they essentially just go through the steps, and that will happen generally in last 24, 48 hours when you're trying to revise. You obviously can't practice everything, but ensure in that case, mentally you are essentially going through those steps, at least for 1 or 2 of the questions in each of the topics, right? Mentally, so that you know exactly that this is what has to happen in the next step. So you are tuned to that. Gear up for that accordingly. Okay?
Excuse me, sir.
Yes.
Sir, have some urgency. क्या मैं मीटिंग लीव कर सकती हूँ?
Yes, please, ma'am. No worries. All the best, beta. You can
Thank
always catch up with this session subsequently also.
Thank you, sir.
Okay. All right. Thank you. Thank you for participating, my dear. All right. Shall we solve one more question, or I have a couple of theoretical concepts which I wanted to share. How would you like me to go about it? Do you want me to take up the theoretical concept of gift city, etc., or should I essentially do one more sum?
One more sum, sir.
One more sum? All right. So let us take one more sum then in that case, which is just 1 minute. I want to try and have the sum where we can cover as much as possible, right? Okay. So the good sum. Again, this sum has been solved by us earlier in the regular sessions, and thus I would recommend. It was just 2 sessions which we had done on international financial management, where we had covered almost 10 to 11 questions, right? So you can see over here, I have the sheet also over here. So this is the question that we will now touch upon. Question number 10. I'll take that particular question again over here in the file. Okay, I hope this is visible to everyone, or should I increase it further?
No, it's okay.
All right. Okay. So this is another question where we are going to essentially calculate one element which we have not covered in the earlier ones, is where you have CFAT growing at particular percentage in perpetuity. This is something that we have done in dividend growth model as well, remember, where some number is increasing and growing in perpetuity. So let's do this one. A proposed foreign investment involves creation of a plant with an annual output of 1 million units. The entire production will be exported at a selling price of USD 10 per unit. At the current rate of exchange dollar, cost of local production equals to USD 6 per unit. Dollar is expected to decline by 10% to 15%. The change in local cost of production and probability from the expected current level will be as follows. So decline in value of USD percentage, if it is 0, reduction in local cost obviously will be 0. Probability of that happening is 0.4. There is a possibility that if there is a decline in value of USD 10%, that will essentially bring reduction in local cost of production of 0.30. Probability of that happening is 0.4. And last one is 15% decline in USD, 0.15 additional reduction, meaning total reduction will be how much? 0.45, right? And probability of that is 0.2. The plant at the current rate of exchange will have a depreciation of USD 1 million annually. Assume local tax rate as 30%. You are required to find out annual cash flow after tax under the different scenarios of exchange rate. Expected value of CFAT assuming no repatriation of profits. And third, viability of the investment proposal assuming an initial investment of USD 25 million on plant and working capital with a required rate of return of 11% on investment, and on the basis of CFAT arrived under option 2. What is option 2? Expected value of CFAT assuming no repatriation of profits. And the second aspect again were mentioned over here is the CFAT will grow at 3% per annum in perpetuity. Right? All right. So now let's start first and foremost annual cash flow after tax under all 3 different scenarios of exchange rate. So how do I go about this? I have scenario 1, which is decline. So I have 3 scenarios. Scenario 1. Now we have scenario 2. And next one is scenario 3. Okay. All right. So here, what will be my annual sales in units? Will there be any change? Annual sales unit. How much is the annual sales in units? Annual output of 1 million units. 1 million. That is 10 lakhs. Right? What is my selling price per unit? Selling price per unit. 10. No change in selling price, am I right? I will have cost savings if in the first case there is no savings. You can see over here, so that is going to remain at $6. In the second case, there will be reduction of USD per unit of 0.30. So it will be 6 minus 0.30. It will become 5.7. And in the last one, you are told it will be additional 15 cents, meaning it will be 5.7 minus 0.15. Are you with me? Okay. So that brings profit per unit to $4. Here it will be 4.3. And 4.5. Okay. All right. So amount wise, it will be how much? Total profit, how much? Profit per unit multiplied by number of units. Are you with me?
Yes, sir.
That comes to 44, 43 lakhs, and then 44 lakh 50,000. Right? Further, I have to subtract over here depreciation. How much is depreciation? I am told the amount is how much? What is the depreciation?
1 million annually.
The plant at the current rate of exchange will have a depreciation of USD 1 million annually. Right? Okay. So I have 1 million, that is 10 lakh for the first scenario. For the second scenario and third scenario also, will it remain 10 lakhs only or will it change? Please read this line and tell me then. Try to connect with this line and then tell me. Here. Will this reduction have any impact on your depreciation also? Yes. It will be 10 million, sorry, 1 million, 10 lakhs into 1 minus your decline in value is 10% of USD. Am I right? So it will become lesser. Why did I do that? Why did I do that? Tell me, anyone? Why did I do that? 2, 1 minus 15%. Why is my depreciation reducing? So in current terms, when I'm doing the calculation in current terms, depreciation is 1 million. But if if your currency depreciates by 10%, that means effectively, as far as today's value is concerned, it is as good as 9 lakh in that case, the depreciation which I can claim. Right? Similarly, if the currency is going to decline by 15%, so as on today's date, if I'm going to compare, today is, say, for example, no depreciation, but you are expecting depreciation of, say, for example, US currency depreciates by 10% or 15%, that means the amount, it's a fixed cost, so it will remain same, right? However, because you are doing all these computations in dollar terms itself, so effective benefit that you'll be able to take because of that is going to reduce. Are you with me? So now profit before tax will be 3 minus 10. Less tax, you get profit after tax. Then once I have profit after tax, I will add back what? Depreciation, because that will help me in my cash flow. Compute cash flow. Now, how much is tax? Tax rate is how much?
30%.
30%. 30 lakh into then depreciation is added back and so I get my expected cash flow in all three different scenarios. Right? Now you are given a certain probability. What is the first question saying? Annual cash flow after tax under all the different scenarios of exchange rate. So what will be my expected value? Expected value of cash flow. That will be how much? That will depend on, yes, it will be 31 lakhs into, what is the probability of 31 lakhs? 0.4 plus 32 lakh 80,000 into probability is again 0.4. ये कहाँ से मिला? Where am I getting this? It's there in the probability in the table, right? Plus 33 lakh 70,000 into 0.2. So I get 32 lakh 26,000 as expected value of cash flow. Or you can say probabilistic value of cash flow. Okay.
Yes, sir.
So first, annual cash flow after tax under all three different scenarios. So we have found this. This is my point 1. And second one is expected value of CFAT assuming no repatriation of profits. This is probabilistic, right? So I am multiplying with probability. I got that. Next is viability of the investment proposal, assuming an initial investment of USD 25 million on plant and working capital with a required return of 11% on investment on the basis of CFAT arrived under option 2. CFAT, this one, right? All right. So, and on the basis of CFAT arrived under option 2, CFAT will grow at 3% per annum in perpetuity. Fair enough. All right. So, first of all, expected CFAT is the same amount. Right. Further, I am told growth rate. Kitna hai? How much is that? 3%. Right? Required return. Required return means KE. Am I right? Am I right? Required return is KE. So, what will be the expected value? What will be the expected value? Expected value of inflow. Rather, I could say CFAT in perpetuity. So, when we were calculating for dividend, how we would do is we used to calculate by saying it will be D1 upon KE minus G. Remember, this is how I would get the price of my share. Now I am trying to find the value. So instead of price, I am trying to find value. The denominator I will still have KE minus G. The denominator KE minus G, numerator will be CFAT. Are you all with me? So expected value of CFAT in perpetuity will be how much? This will be 3226 divided by 11% minus 3%. Okay, so let's do this. So now it will be 3226 divided by 11% minus 3%. That comes to 4032 500. 403 25,000. So 4 crore 3 lakh 25,000. बराबर है क्या? 11% minus 3%. There is one thing which is missing. What is missing? Here it is D1, right? And what I have written is CFAT at the end of year 5. This is 0. How do I need to do that? What do I need to do? How do you get D1? Yes, how do you get D1 from D0? Anyone?
Increase by 3%.
D1 is equal to D0 into 1 plus G, isn't it? Remember? So here I need CFAT 1. I have written CFAT. So how will I get CFAT 1? I will need to multiply it with 1 plus G. So in the numerator, I will need to multiply it with 1 plus 3%. So what I am doing is 32 lakhs 26,000 into 1.03 divided by 0.11 minus 0.03. Yeah. So it comes to 4 crore 15 lakhs 34,750. 4 crore 15 lakh 34,750. This is the total value of CF18 perpetuity. And what is your investment, initial investment? Yes. Less initial investment. It is given to you over here, assuming initial investment of 25 million. So I will say 25 million, that is 2 crore 50 lakhs. So is my NPV positive or negative over here? Yes, my NPV is positive, am I right? Again, you have to give the decision. What will be the decision? If the NPV is positive, project should be accepted or project is viable, because here the question uses the language viability. Examiner is not going to be that biased about just the word viable is there or not. When project should be accepted is okay. Is this clear to everyone? Okay. So today we did the revisionary session on international financial management. Remember, the moment you say international, foreign exchange, across the border, basically you are doing transactions. So this financial management would require to manage your foreign exchange risk. And you are essentially doing some transactions across the border. So predominantly there are going to be questions about how to use the funds, where to raise the funds in ADR, GDR, etc. Capital budgeting decisions will be there, working capital management decisions will be there, and dividend decision, which is very crucial, right? Thereafter, we have two different methods in which you can do your computation of returns. One is your home currency approach, the other one is your foreign currency approach. We have used that as well, and thereafter we have done a couple of questions further on viability of the project based on the required rate of return given, and how to compute again from one required rate of return of, say, domestic currency into foreign currency and vice versa. Okay, there was one adjustment which I had especially covered, which is very essential over here, which we had considered over here. Remember, where you are converting, you had see this one, where you are getting 8% return in required return in your INR currency. 6% was the risk-free rate, and risk-free rate of the Sri Lanka was given to us, right? Now here often students essentially take 8% upon 6% into 5.2%. Please do not make that mistake. Please take 1.08 upon 1.06. And the reason for that is you take 8 upon 6. This is wrong because it appears as if you are going to earn 2% on 6%, which is 33.33%, which is wrong, right? It is 2% on 1.06. So it is 1.08 upon 1.06 into 1.05. Okay, please do not forget that. With that, we come to the conclusion of our session. So, thank you to Ajit, Saminath, Mukesh, Shweta, Prashant, Resham. Any questions? Any questions, my dear? Shweta? Prashant?
No.
All right. So with that, we conclude for the day with this session. Okay. Again, I suggest, please refer to the two sessions which we had done and recorded and put it up on the YouTube on 6th December and 9th December. Please refer to them because there we had solved almost 10 to 11 questions, right? So please go through that. Okay. All right. Thank you very much.
One second, sir.
Yes, sir.
Good morning, students. And there is an announcement for you. the session of FR which is held tomorrow, the topic is changed. So please prepare accordingly and attend the session. The FR session for tomorrow, the topic has changed.
What is the topic, sir?
Please check the schedule once.
Okay.
I have updated.
Thank you. Thank you.
Okay, thank you, students.
Thank you, students. Thank you, everyone. Thank you, Shweta, Resham, Seminar, Prashant, Mukesh.
Thank you, sir.
Yes, sir. Thank you, Ashok ji.